Hello everyone, welcome to my YouTube channel. My name is Vishal Gaikwad and today I am going to present on top-down and bottom-up approach of fundamental analysis. So let's begin. What is fundamental analysis? We'll study that first and then we will study the methods, that is top-down and bottom-up approach. What is fundamental analysis? In accounting and finance, fundamental analysis is the method of assessing the intrinsic value of a security by analyzing various micro and macroeconomic factors. The ultimate goal of fundamental analysis is to quantify the intrinsic value of security. Its intrinsic value can then be compared to its current market price to help with investment decisions. Fundamental analysis aims to determine the correct price, that is also called as true value, of a security. By knowing the right price, an investor can make an informed investment decision. Security can be overvalued, undervalued, and fairly valued. Next. Now we will study the types of fundamental analysis. There are three types of fundamental analysis, that are economic analysis, industry analysis, company analysis. In economic analysis, the economy is studied to determine if overall conditions are good for the stock market. In industry analysis, the company's industries obviously influence the outlook for the company. Company analysis. This is usually done by studying the company's financial statements. There are two methods for finding the fundamental analysis. They are top-down approach method and bottom-up approach method. Now we will study top-down approach method. Top-down approach method, first we select the economy and then we select the sector and then industry and then the company. As a general rule, the top-down approach begins with a high-level view towards the global economy and from there moves towards a more narrow view of a specific asset classes and global industries. Top-down approach. Analysis starts with consideration of health of overall economy, analyzing various macroeconomic factors like interest rate, inflation, and GDP levels. Determine overall direction of the economy and identifies the industries and sectors of the economy offering the best investment opportunities. The investor assess specific prospect and potential opportunities within the identified industries and sectors. Finally, they analyze and select individual stock within the promising industries. Now we will study about bottom-up approach method. In bottom-up approach method, first we select the company, then the industry, then sector, and then the economy. Here, the bottom-up approach method starts from the specifics and moves towards a more general view of the overall economy. Analysis starts with analyzing individual stocks, analyzing various microeconomic factors such as companies' earning and financial metrics to gain better understanding of companies' operation. The analyst will then incorporate the finding from their research as part of a valuation model to help determine if the company's share are over or undervalued relative to the rest of the market. Some wealth managers may also opt to take the level of analysis one step further by aggregating their forecast for individual companies in order to arrive at an outlook for a specific industry, sector, or geography. Now we will study combining top-down and bottom-up approach. There is no single approach that is right for all investors, and the decision between top-down or bottom-up investing is largely a matter of personal preference. But it's worth noting that these two investment styles are not mutually exclusive. Most portfolio managers find it's best to employ both approaches when developing their economic forecast. Combining top-down and bottom-up research. Many investors combine top-down and bottom-up investing when building a diverse portfolio. For example, an investor might start with a top-down approach and look for a country that's likely to see rapid growth over the coming years or two. They might take a bottom-up approach within that country by looking for specific investments, such as company with low price earning ratio or high yields. The key to a successfully using this technique is identifying the correct criteria and analyzing them in a wider context. For example, if price earning ratio are depressed in a specific country, it is due to a large macroeconomic risk factors such as an upcoming election or conflict. Investors must carefully consider all these factors when making investment decision to avoid making any costly mistake. Now we will see the conclusion part. There is no single approach that is right for all investors, and the decision between top down or bottom up investing is largely a matter of personal preference. But it's worth noting that these two investment styles are not mutually exclusive. Combining top down and bottom up approach gives the better results. Thank you.